SD Bullion.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, Eric, in the aftermath of the historic attack on the gold and silver markets that began 2 weeks ago, really as could be expected, gold and silver have put in one of the largest and sharpest rallies of the entire bull market over the past 10 days. Gold has now retraced almost 60% of its move to its lows near 1320 and closed the week today above crucial support at 1450. And silver held on late in the session for a close above 24. All the signs really seeming to be indicating that the bottom is in and that the worst is behind us, particularly with gold. Although late in the session today, the shares did kind of take a beating. And really, ordinarily, I would suspect one last Hail Mary attempt by the cartel next Tuesday through Wednesday, really with a combination of China being closed Monday, Tuesday, and Wednesday for a holiday, as well as the May FOMC meeting on Tuesday and Wednesday, and the release on Wednesday of next week on May 1st. But at this point, the physical demand really seems to be so strong and insatiable that the cartel runs the risk of completely running the wholesale gold and silver markets dry were they to attempt to shove gold below 1,300 and silver down towards 20, Eric.
Yeah, and I think silver 22, as I've been saying for a better part of almost 2 weeks now, would have JPMorgan in the money on their net short position on an average basis. So they really, if I'm right, and based on the timeline of their actions in the marketplace and the available contracts that they could have been playing with over the course of that 2-3 year period or so, and just the prices that we see over that period, I think that theory holds a lot of water and probably is correct. And so far, everything that we've been seeing is matching up in a way that would suggest that they're being influenced by that more comfortable position that they're in now when it comes to the management of their management effort of bullion prices. So, as I said earlier in the week, I think that we'll probably be bouncing around somewhere with a $25 cap on silver for, maybe a couple of weeks, just so that they can unwind a bit of their short position and diffuse the level of liabilities that those guys are carrying. Yet at the same time, they whatsoever to bust below 22, unless if they wanted to execute some kind of a scorched earth policy in service of the interests of the Federal Reserve and Treasury and the support of the dollar in the bond market, et cetera. As it stands, that now has a much greater level of risk to the cartel in general, and certainly amongst those who believe that silver is the Achilles heel of the whole cartel cap effort for both gold and silver, because the physical demand is going off the charts. We have a report just today coming out of the Chinese Gold and Silver Exchange Society, which is based in Hong Kong, and those guys are kind of like a user group. They're the main group that is supporting all of the refineries, or many of the refineries in China, and many of the higher level jewelry providers, and it would probably account for maybe something like 70% or so of the jewelry that Chinese citizens are buying are flowing through this organization. So anyway, that is context. These guys reported today that they're needing to replace their inventory at a rate that's 4 times their normal order rate. So we can take from that the fact that the wholesale distribution chain has been blown out of the water in China. The largest bullion consumer in the world, China, has an inventory chain for their domestic consumption that's been drained out. So when we look at that and compare that to stories that we see with respect to bullion products in the United States and Canada becoming much harder to obtain, it confirms what we see. This is not just a story where certain groups are just buying the dip. I mean, it's worldwide. The physical market's on fire, and it should stay that way. And it would certainly run the risk of even greater demand upsetting the timetable and ability of organizations like JPM to manage the market overall, because in the long term, the physical market will, in fact, put pressure on the paper exchanges, and that's probably a good time for us to transition over to talking about JPM and their movement of gold from their inventories and their position on the COMEX. I mean, there's some really strange things going on this week.
Right. JPMorgan's just been seeing a massive draining or withdrawal of gold, especially from their eligible category. Yesterday, Just yesterday alone, well, it was yesterday's report, so it would have been Wednesday's trading, but 261,000 ounces of gold withdrawn in one day. I mean, we're talking over 8 tons, nearly 9 tons of gold from JPMorgan's vault in one day. And quite a few different sources we've been hearing actually that it's big money in Europe that is getting out, and they're going. They have allocated positions and they're demanding their gold back. Heard a couple sources inform us that we're talking about big money that is going and basically demanding their allocated gold from JP Morgan vaults, and are threatening to totally take all their funds if JP Morgan doesn't deliver. And so you're seeing JP Morgan's eligible vaults being drained, continue to see the GLD inventory plummeting. And what's interesting with GLD, even in the last week and a half, with the gold price rebounding, the inventory drain continues at the GLD.
Right.
Massive draining of physical gold and from JP Morgan's vaults. And then, on the retail side in the U.S., the shortage just continues to exacerbate and worsen. The wholesalers got their allocations Monday morning this week, and by Monday afternoon they were sold out. They've been sold out for the rest of the week, the main wholesalers. And later in the week, it started to spread really to the bigger bars. As of today, on Friday, the 100-ounce RCM, Royal Canadian Mint bars, you're looking at a 4 to 8 week delay for 100-ounce silver bars. So what that tells you is all 1-ounce rounds, coins, they're just totally gone, and the public is buying up. The only things left are the 100-ounce and 1,000-ounce bars. So
to me about offline about the Buffaloes and your sales flow.
With the premiums exploding on the mint products, the Canadian Maples and the Silver Eagles, really the retail demand that we've seen at SD Bullion has just exploded in the generic 1-ounce rounds that we still have available, where they're still available in around a $2 to $3 premium over spot. Now that's a $4 to $5 discount over something like a Maple or an Eagle, and on percentage-wise, that's a pretty massive difference on the premium when you're talking silver $23, $24 an ounce. So the demand for the generic rounds has just skyrocketed, and the supply of those is rapidly vanishing as well. And
your supplier still is quoting a delivery time availability too that's much shorter than what we're hearing from the U.S. Mint and other places, right? I mean, it was 2-3 weeks?
Right, the private Buffalo rounds are still shipping immediately. We're still getting those in pretty immediately. There's not really any of a delay like we're seeing on really anything that's either been previously minted, like say the 90% just totally gone. You can't get that anywhere at a reasonable premium anyways, and even we're talking $5 to $6 over spot, and you're at a 4 to 8 week delay. And then any of the mint products, especially the Maples and the Eagles, and the Austrian Philharmonics. Shortage was worse last week. It eased up a little bit this week, but still, I mean, you're talking a premium anywhere between $3 to $5 over spot on the wholesale side. So just a vastly different ballgame from a couple weeks ago.
Right. It seems as though the premiums earlier in the week and certainly last week were a little bit higher. We've seen a slight decline in premiums, particularly with things like Silver Eagles from the U.S. Mint. But on the other hand, it seems as though the deliverability factor is being pushed out by the main suppliers, the U.S. Mint, the Royal Canadian Mint, and in turn is speaking to the fact that the wholesale chain has been drained out of supply. So we had this burst of demand. The wholesale chain was able to meet it to some extent, to greater or lesser efficacy, but at the same time, it still had coin dealers freaking out and trying to manage their business with the necessity of having large spreads, because that's unfortunately just the way the businesses have to run. And a lot of people criticize that, but that's just a product of the way this industry runs, given the risks associated with managing inventory, et cetera. So at this point, if we were to try to derive some kind of a market intelligence interpretation of what's going on, it seems as though premiums might begin to tick up once again starting next week, maybe later in the week, particularly if the gold cartel and silver boys at JPM decide to pressure metals and create even more demand if prices decline. So that would be something to just kind of put in the back of all of our heads, all of our listeners, just keep that in the back of your mind and see how the week unfolds next week. It'll be pretty interesting to see when we return on Friday if, in fact, that indication of further push-outs in terms of the supply chain begins to manifest, because that'll be a predictor of the price over the course of the next 5-week time frame, as opposed to just 1 week ahead.
Right, exactly. And I mean, you have to take into account, we have seen really a $3 move in silver off the lows of 22, just about anyways, which is about a 15% move. So that definitely is a factor. And I can guarantee you if they make another run at 22 and that breaks, premiums are going to be crazy, going to be surpassing 2008 premiums. But as far as your comment earlier, yeah, it does seem that premiums may be easing very slightly on Eagles and Maples here, but it looks to me like there's not really any let up in the supply side delay. So it looks to me more like a little bit of a demand let up. This is pure speculation, but the way I look at it, I think anyone who was interested in buying silver thought 22 or 23 was a great deal. They put all the capital they could towards it, and it'll be a couple more weeks before they can reload to invest further capital. Now, if we break 22, you're going to have more money that's been sitting on the sidelines waiting for 17 or 18. It's going to come into play. But I think that's what might be behind the little bit, and it's really only been a slight easing in premiums, if any, in those products, but it's certainly not from any increased availability from the mints.
Right. Another thing, too, that is probably worth pointing out again, we've touched on this before as well, is that the whole buying frenzy that started from April 15th's mega crash was something that was seen worldwide, but in America in particular, and in Canada to some extent as well, too, the buying that we saw was qualitatively different in its nature. I mean, we had buying in 2008 that was primarily motivated on people having extreme concerns about a banking system that quite literally came within hours of totally crashing. And that kind of I must have insurance panic buying from a basic motivational level for the buyer is qualitatively different than bargain hunting buying. And investors don't always go for bargains. I mean, a lot of times when prices on assets decline, investors step back, they adopt a don't catch a falling knife philosophy, and are just waiting for some kind of bottom to set in before they step up to the plate and buy. But the fact that we have this huge wave of physical buying in America shows that a lot of people are just beginning to understand the fundamentals of silver, and they're also very skeptical of the banking system and counterparty risk issues in a post-MF global world. And it speaks to the fact that there are more people who are becoming educated about the fundamentals of this market, and in the long term, that's a very, very healthy dynamic. And I can't stress enough the fact that this is pretty unusual. In my estimation, I'm not 100% sure, but I've been watching this market since 2000. I can't remember a time when we've had a decline. I mean, this one was huge, but certainly on a huge decline where investors were just diving in strictly because they saw it as a value purchase as opposed to buying insurance because the world was burning down to the ground immediately, and they were fearful of not being able to buy gasoline or food in a week or so if the whole country shut down. So this is different, folks. There's something very unusual going on in the background when it comes to the aggregate level of awareness amongst the people who are moving in the market as new buyers, and then the people who have just been here all along are buying more. So that's definitely something to keep an eye on in the weeks and months ahead.
And just a little bit of anecdotal support for that theory that you just pointed out there from our retail perspective with SD Bullion. We've just seen a skyrocketing in the last week and a half of credit card purchases, especially for silver. And so that's not fear panic buying to save your assets. That's what can I do to scrounge up some capital or some credit to purchase this asset on sale.
Everybody get out there and go to the garage sale this weekend, and then go get some money and buy some bullion.
Right. All right. Well, for the week to come, again, China's closed Monday through Wednesday, as well as the FOMC meeting on Tuesday and Wednesday with Report Wednesday. So expect continued volatility. Really, anytime with those two combination of things coming together, really can anticipate or expect anything as far as what the cartel throws at the paper markets. But If they push too much further, there's not going to be any physical left whatsoever. So should be a pretty interesting week, Eric, and look forward to wrapping it up next week.
Sounds great. Thanks you all for listening in.
All right, well, that's a wrap for this week's show. For the Doc and Eric Dubin, thanks again for joining us on the SD Metals and Markets Wrap.